All right, good morning, everybody. The short week continues. Just let me adjust a couple of settings here. All right, so I have continued to migrate the charts. If you have an opportunity to check out the YouTube description, you'll find some of the TradingView charts that we spoke about yesterday. They're not all there. I believe that the anchored VWAP, which I don't show much in this stream in the mornings, but it is one that I use. Probably going to start showing it more, really. We're seeing a significant move through the morning session. Really just kicked off in the last 45 minutes or so. Small caps are down the least. Japan down 0.5%. So we're not holding firm and waiting. We're on the move. We've got the president speaking today. They said something about 8:30, but he was delayed by 2 hours, and so he might not speak at the scheduled time. I heard they made that time up and that he's back on track, but just be aware he might not show up to speak on time. There was something wrong with his airplane and they had to turn around and go back, and then he had to wait for 2 hours to get a backup plane. So we'll see how that goes. But we also have Christine Lagarde today, later in the day, and we have the 20-year auction. And that's kind of a big deal. We're not supposed to have favorites, but I pay particular attention to the 20-year bond auction. And that's at 1 o'clock today. So just really, be mindful of that. Yeah. Yeah. Maybe run out and trade Boeing, huh? It's it's Air Force One, so whatever plane that is. There's a lot of talk about the Supreme Court, um, and the possibility that they may come out with a decision. It's unlikely that they do it so soon, right? But I mean, it's absolutely possible it could happen. Just I wouldn't sit there day after day waiting on it. And who knows, maybe this sell-off is because somebody knows that the decision is coming. Just it seems like everybody's hung up on waiting for that decision, and I wouldn't get fixated on it. Remember to keep circling back to the CME FedWatch, because one of the biggest drivers for where the market is going to go next is going to be the market's pricing in or unwinding what they priced in when it comes to the rate cuts. So for every new economic data piece we get, circle back over here and see if that new data point is changing the projections of a rate cut or no rate cut. Don't bother with January because that's already a done deal. March is pretty locked in, but it could move. I would focus on April and June for really anything that starts to get unwound or priced in. All right, we can see the schedule risk probabilities is really high. It's extreme, right? It says right there. Extreme risk based on current schedule. So first he's doing a greeting, then he's doing the special address, hopefully on time. We'll see how that goes. So that's going to be a really big part of the morning. If market makers want to just stand aside and, you know, sell it, who knows? That's going to be one of the big ones. All right, so as I mentioned, the YouTube description has these YouTube charts or the trading view charts. The only ones that it doesn't have at this point is options related charts that it just can't have, and an anchored VWAP chart, which I don't normally show in my streams, but it is one that I use every day just to kind of get a feel for what's going on out there. If you haven't really gotten into the anchored VWAP, then you're missing out. Brian Shannon has done extensive work on this. He's kind of the go-to for anchored VWAP. Good morning, Sophie. Yes, it's recorded. I have a YouTube channel, which is what I was just discussing. The charts that I'm using in this are in the description on that YouTube. The YouTube channel is linked with the link that got you here. So if you was just to go back to wherever you found that link and read it closely, you'll see that it says replay link, and you can click that and it'll take you to it, right? This is the anchor to VWAP chart that I'm referencing. Each month has its own anchor. This is a bit extreme or a bit much. You don't need all of them necessarily. It depends on the sort of analysis that you're doing. A lot of times just your year-to-date anchored VWAP works just fine. It's just that in the front of the year when you're, when you're in January and getting a little bit into February, you don't have much of a year when it comes to your year-to-date anchored VWAP. So spreading it out through the multiple months where each month has its own anchor, as you can see, we leave so much of it behind that it's no longer useful or relevant. Don't necessarily need them unless we was to significantly turn in the other direction. But that would be the idea, right? So I'll very likely be adding that chart to the other charts. And then all of the TradingView charts should match the Thinkorswim charts that we use every morning. Yeah, I do need that, don't I? All right, so let me update the spot gamma levels for the day. I did it on my other computer. I just haven't done it on this one yet. I share this every day. It's the spot gamma levels. And then, of course, I've got another link for the OEC levels because spot gamma does the indexes. Mine that I share does my watch list, so it's got equities in it. So we can see we're through the put wall again. The put wall did move, so of course I shared a picture of that movement. I won't share a picture if it didn't move, right? That's kind of the idea. So if the put wall is in the same spot as it was yesterday or the call wall, then I won't share a picture. Otherwise, if it moves, then I'll share a picture. We're through the put wall, still underneath the 10-week. We're underneath all the dailies. We can see that out here on the daily, even though I have those daily and weekly moving averages on my 15-minute chart. Sometimes it's easier just to see them on the time frame they reside in. So here's the daily. We've got a 310 cross. That's a bearish 310 cross. It's also called a bear surge. And we're dragging the 10 through the 20. So the thing that I'm focused on right now is something that looks a lot like this. It's kind of my bias at the moment. How soon are we going to turn around and go the other way? Will it be this V shape that I just drew, or will it be more of a cup style reversal like that? I don't know. Neither does anybody else. I still haven't gotten my magic 8-ball. Maybe someday I'll get that. So that's what we're on watch for. I mentioned yesterday if we break 68.50, then it puts on the table 67.50, right? Because we're running 50s. I've been adamant about these 50s for a while now. It's not new. We closed underneath 68.50. Right now, we need to get outside of yesterday's price action, which we are. We have an inside day breakout. If you haven't heard me talk about it yet, as far as I'm concerned, there is a significant difference between a double bottom, which is a bear trap, and an inverse cup, which often has a handle on it and then goes down. If a double bottom and a inverse cup both look the same, then how do we differentiate between the two? And for me, it comes down to exceeding the previous low. If we exceed the previous low, then we've initiated a bear trap because we broke the pivot. It looks like we're going down. Bears pile in. And then, of course, we got to capture them, right? So we actually have a trap. It's been triggered. People have entered into it. We trap those bears, squeeze them till they pop, and we turn the double bottom into that trap and we rip to the upside. But we need that really fast rip to the upside to validate that you actually trapped somebody. If you don't squeeze the bears and get the rip to the upside, then it doesn't have the validation that you actually triggered a trap, right? So we don't want a lazy recovery off that low. If we come down and we match that low and we don't exceed the low like we did here, it's more likely we're forming an inverse cup, in which case we'd look for a handle and then we'd look for a continuation to the downside. So for me, it always comes back to where's the original pivot and did we exceed that pivot or not? Now, this isn't a forever thing or an always thing. You can get one that turns out to be another. So, we just work with what we got. Why did I even bring all of that up? Well, look at what we have this morning. There's either it was going to be a cup and possibly a handle, or it was going to be a bear trap. We didn't know which was going to be which unless or until we broke the previous pivot point, which we did. That triggers the bear trap scenario, but we didn't get the follow through. It should have been a significant rip, right? We should have had those bears trapped, squeeze them till their heads pop, and the violence of that push should have gotten us into at least the previous 786 area, so somewhere up in here, and it didn't, not even close. And what happened, it just stalled out, rolled back over. So from a bear trap perspective, it didn't get much work done, not at all. But that's generally how I tend to focus on these. Same thing with a bull trap. You could just flip everything over again. And, you got a double top versus a bear trap, a double top versus a cup and handle, a regular cup and handle. And whether or not we overshoot that top would be designed on whether or not we actually got some bulls in there or not. So this has failed. If you put the 111 on there from yesterday, we didn't reach it, which was one of the reasons I thought the reversal seemed a bit off, right? The reversal came too soon. So yesterday's low. You can see how we missed the 111. So that recovery back the other way seemed fake to me anyways, simply because we were coming back the other way after missing this really important piece of the puzzle. Unfinished business is how I'm looking at it right now. We could go on back down there and get to 68.11, overshoot this into the cog line, right? 68.11, which would also be yesterday's 111 and would be a more structured place to try to run that. The problem with that logic is we already burned so much of our fuel in this fake move that even if we do come on down there and get to the 111 and then try to go, well, if you tried to spring a trap and it missed, it's going to be a lot harder to spring the trap a second time, right? That's kind of the way I'm looking at it. So even if we do get down there now, we very likely won't have the participation we need to get that strong reversal and push back into 68.32 cog line. That's what we should have run into. If it had all worked out the way it was supposed to, we should have reversed back up into this 32 area, and we didn't. We're not very likely not going to now. We'll have to grind our way back up, something that looks a little more lazy and hazy like this back here. Either way, don't get too hung up on the bearish side of things this morning. I know it's easy to do after a big down day like yesterday, and we're starting down again this morning. Just keep in mind this previous move here, all right? I know new traders always struggle with what we have now versus what we're looking to see next. And, for sure you got to walk a tight line, but at some point you have to think about what's coming, not just what we have. So we are through the put wall. We've got these spot gamma levels down here. They're not the major levels like a call wall, put wall, zero gamma line, anything like that. But they are levels. And if you was to read the spot gamma material, they have a free FAQ that it describes all these different things, and it's a place where you can ask questions and find out about all the different tools that Spot Gamma has that explains a lot of these lines and levels and why they use them and how they got the data and on, right? All that stuff is free. They give it to the public. If you was to read that stuff, you'd find out that we hit those levels more than we hit a put wall, a call wall, a zero gamma line, which makes them more relevant just because we interact with them more often. Unfortunately, right now for us, we don't have another level until 6782 when it comes to spot gamma lines. We still got cog lines, round numbers, measured moves. We've got things down there that we can interact with. We just don't have any more spot gamma levels until we get into the 80s. Look left, we have this pivot back here, but that's 6770. We got a ways to go. We'd have to overshoot that 80 area. And of course, if we get that close to the 50, then that's where we're headed in my eyes. So that would be 6750 on the table. I'm still not bearish, right? This is nothing more than a part of the wave that we've been running. These previous examples can show you exactly what we're kind of anticipating. This isn't a 2022 bear market. We're not looking at, 6 months of downside activity. We're not even looking at the previous tariff scare like we had at the first part of last year. It's not that environment yet. So things could change. It could all evolve. But for right now, all of this is not what we're anticipating. So don't get all bared up and start changing over your portfolio into something that is designed to profit from this environment, because we don't have that environment yet. We got a lot of participation in the last 2 days. On the one side of all of that is good. Right? It got kind of thin through the holidays, as it always does. Now we're into the new year, short week, and we've got a lot of participation. The move through the European session and the kill zone really didn't come through, right? That's from 2 to 4. And sure, right at the end of the kill zone, we finally got a little bit of that move. But by then, we were already in the throes of what we've got now. We do want to focus on reciprocation. I know, big fancy word early in the morning. It just means that you get the same amount on both sides, right? If you get a 0.5% move on one side, you expect a 0.5% move on the other side. You can just draw that out, right? And you can see that that takes us back to the 10-week. Now, that's a projection because I don't know where VWAP will be when we finally cross back through VWAP. That might be somewhere around 9:35, 10 o'clock. It could be at 1 o'clock this afternoon. And VWAP could be a lot lower at that point. Whenever we do finally get across VWAP, then you can measure the distance that we traveled away from VWAP on the one side, and you can place it onto the VWAP for the other side, and that's going to give you your target. Right? Basic measured move logic. You would do the same thing for a trend and a pullback. It's the same kind of tool, the same measurement, same logic. Candle textbook analysis 101, right? I'm sure every trader has studied their candle book. Right. We are getting close to the 6811 cog line, which would also be the ADR half. This is one of those charts that is shared in the YouTube description. If you haven't had an opportunity to go over there and like and subscribe those videos and to my channel, help me grow that thing out. Share it with your friends, right? Get people engaged, get them involved. Find these charts over there, then you'll have them for yourself. This is the lower ADR. We haven't hit it yet, which kind of adds in with the idea that I think we've got a little more to go to the downside. I would like to get to 6811, which is the cog line, but it's also this 111, right? So it's lining up. It's got the ADR half, yesterday's 111, the cog line. That's 3 different reasons why we should just go on down there and get it done. Once we get there, it opens the door for us to go to the other side. I wouldn't see that as bullish or bearish. That would just be price doing what price does, right? It's a part of the wave that price creates. You can see just a general simple logic. We don't move in a straight line. But we got to get there first. If we get there and we go onto the other side of it, if we get underneath it, then we've got the full ADR down here. ADR stands for average daily range. I'm using a 21-day average daily range. We're looking back over the last 20 days, which is a market month, and we're asking a very simple question. How far do you move on a day-to-day basis? It's an important question because if you think about something like Tesla, it could move 5% every day. If SPY was to make a 5% move just one day, it would certainly get all of our attention, right? And it's made that before and it will make it again, but it makes headlines when SPY moves 5%. It's kind of a really big deal. So if you're going to trade a product, you kind of need to know how far do you move typically on a day-to-day basis? Well, think about it for yourself. If you see something happen day after day after day after day after day, say your neighbor walks up the block, down the block, up the block, down the block, and it's just that one block every day, every day, every day, every day. What do you think the neighbor's going to do today when they go out and they start walking? They're going to go to the block and turn around and go to the other side of the block, and then they're done because that's what they've been doing. Can't they exceed that distance? Maybe they get froggy and frisky and they want to take an extra block? Sure, it's possible. But it's more likely they're just going to do the same damn thing that they did yesterday. That's price. That's movement. That's what we're measuring. So that's the red lines. If we do what we did yesterday and the day before and the day before and the day before and the day before, then we'll just stop within the red lines and we'll bebop between the two like a pinball machine. If we get bullish or bearish, we can move the entire ADR in a single direction. We could be bullish up to the yellow line or bearish down to the yellow line, and that would still be a full ADR. It would just be going in one direction and not splitting it between the two. That's ADR. If we exceed that, then we know the market is going above and beyond its normal behavior and we're doing something extra, something different. We're outside the boundaries of what is normal. We are underneath the weekly floor pivot, not quite at a distance of concern yet. This is only, 2.25%. We do have to worry about mean reversion. We do. If we get past 2.5 and start getting into 3, 3.5, 4, it could snap us back in the other direction quite violently. But we're talking about an upside snap, so I don't think too many people are going to get upset with that. Still, watch that distance from VWAP, and this is by no means a certain math. I've done extensive work on trying to identify distance from the weekly floor pivot for mean reversion, and I did a lot of head banging, right? Just really frustrating work. The top side is different than the bottom side. So the bottom, we can go, 4.5% underneath that weekly VWAP and still not mean revert. But on the top side, getting past 2.25, maybe 2.5, that's about as extreme as you can get before we start to mean revert. Then it depends on whether or not we're already in a bearish backdrop and a bearish market, or if we've been testing these extremes frequently. Right? So if last week we made a 2% move and the week before that we made a 3% move, then this week we could easily go 3.5%, 4% and not mean revert. But if we haven't had those kind of weeks and then we just suddenly get a week like this, it might only take a 2.5% move before we begin to mean revert. So it's a bit frustrating. I don't have good answers on it, but it is something that I continue to watch. How far away are we from that weekly pivot? And how far is too far? Anything more than 2%, it starts to be something that I watch more closely, but I just don't have a great answer for that. For the daily levels, we at least have the SNRs, right? Today's floor pivot is lower than yesterday. That's bearish. Price opened underneath it. That's also bearish. It's a wide channel, which implies if we was to break out that it doesn't stick and we come back in again. And just to clarify what we're talking about breaking out of, that would be yesterday's price. So if we break outside of this box, this wide channel says, yeah, we'll probably come back in again. Just keep in mind that that price is not bullied by a channel. The channel won't make us break out. It won't stop us from breaking out. And it won't make us come back in again. The channel doesn't make price do anything. It's just a tool we use to try to identify what to expect if we were to get a breakout. We have the SNR levels. S1, R1. They are really close to the ADR half lines. 67.92 cog line is down here. If we get to S1, it's probably as bearish as we get. S1 owes us R2. R1 owes us S2. That is straight out of the textbooks. Any volume profile and floor pivot book will talk about these sorts of things. It's a very common system. Just remember that these SNR levels, they're nothing more than math. It's a derivative of yesterday's high and low and close. with some extra funky pieces to it, but it's just a math formula. And if you was to Google floor pivots or floor pivot math, then you'll get the formula, which is kind of neat, I guess, if you're a nerd like me, because then you can use that same formula and mark out hourly bars, 30-minute bars, 15-minute bars. You can have all kinds of fun with it. The main thing we want to look at this point is we have a MDP. It's a missed daily pivot. We have not hit the pivot. And we haven't yet hit the S or the R line. So it's more likely than not that we will hit at least one of those. Price hits its floor pivot more than it misses. And we're underneath that floor pivot. We don't want to get the count started for the consecutiveness of it, right? Yesterday, here's our floor pivot. We didn't hit it. That is a missed daily pivot. And we're underneath it. So far today, there's our floor pivot, and we haven't hit it. Now, this doesn't count yet as a missed daily pivot because, well, the day's not done, and we could run up and hit it at any time, and then we wouldn't have missed it. We would have hit it. If we make it through the entire day and we don't hit that pivot, this would be day 2 of a missed daily pivot. And then we start getting into the consecutive counting, and it can get really negative to the downside. There's some YouTube videos on that if you wanted to check them out. They're not mine. Just search on YouTube for missed daily pivots, MDP, and you should find the guy and the videos that talk about this. I don't trade his strategy, by the way, but I do use it for analysis, as it is with a lot of strategies that I learn. I don't trade them, just use them for analysis. This is telling us the same thing that the ADRs told us, that we're sideways within the range, and even if it feels like we've moved a lot today, we haven't done anything. We're still within the S&R lines, so it's all good. Volume profile for the week, you can see the H pattern a little bit better here. Every time I see that H pattern, I'm reminded of Peter Resnick when he talks about H is hell for shorts. Well, I don't necessarily agree with that all the time, but I will stick to my double bottom versus inverse cup theory. I just don't like the lack of follow through on the recovery here and the fact that we didn't get into the 111. Distribution is scattered. We don't have a classic D shape. We don't have a classic double D shape. We got nothing of value at this point. Really wide value area, and the point of control is down here along the lows, but not at the lows of the value area. So it's really just nasty and disjointed. The reversal here is in this low volume state. We got a high volume, I don't even know what to call that, chunk. It's certainly not a node. Got an entire region up here to deal with. If we was to get back above that 68, 70 spot, but to get there, we got to move through this shallow zone again. And that's if we get an upside break. We got nothing down here except this point of control way out yonder, which we interacted with at that point, and it's likely that we would interact with it again. That's the same level we were talking about earlier, 67.76. That's the way it works, right? How all of our lines and levels just keep highlighting the same spots, even though we're approaching it from different direction with different tools. 67, 75, 76 area. We've already talked about that zone, so this is just another layer right on top of it. If we continue this breakdown, then get through the roundy 6,800, get through that 76 level, and the target is 67.50 because we're running 50s. $10-day, 30-minute volume profile and TPO. The TPO has the classic P-shape profile, right? That's the classic P shape with the point of control in the upper area. But the volume profile is really just a choppy, nasty mess. The point of control up there is likely going to be there for the next week and a half, maybe 2 weeks. Not seeing any reason that it would move at this point. It would take a significant amount of work to get that thing to move. We'd have to hang out in one spot, just dig in our heels and not move and really just build it out. And right now, we have no expectation that we're done expanding. Markets are still looking for balance. They are in alignment, and if we was looking for a new home, then this 68.85 area is a possibility, but we got a long ways to go. We can say that we're working on the candles that made this point of control right now. So over the next 36 hours or so, we're going to wipe a lot of that off the table, and then we'll see what we end up with. 69.60, you would think would be a good area, this zone right here. But we're going to get into those candles next. So they'll likely diminish, right, in that same time period that we're focused on. So where it is now is likely where it's going to be for quite a while. And then we'll have to look for a new home on it. It's a significant resistance if we was to make a move to the upside, but really we just don't have any reason to think we're moving to the upside anytime soon. We had the VPOC from Friday that needed to be added on here. I didn't get it yesterday. And then we have that jumped VPOC. Now, a lot of analysts will do that differently. It really just depends on your style. We crossed it. So, technically it's been broken, but we haven't touched it. So as far as I'm concerned, I'm going to just stick with that. We haven't touched it. We do have 3 layers of resistance, though, to work through, or 3 layers of previous high volume zones that we would need to work through. We can see the work that they put in yesterday afternoon. This is where the point of control is from yesterday. So even though we spent a considerable amount of time there, and of course this is where we've got a lot of that volume, that was the greatest amount of volume. And it didn't take us very long there, right? This looks like defense. The buyers stepped in and tried to defend that level. We're back above it now. It looks like we put in some more work along this area here this morning. Maybe more defense. Otherwise, we ran into something here, and it wasn't there yesterday. See that nice shallow area. There's a considerable disagreement right now. So we'll see how this plays out and whether these guys are going to continue to put in the effort or not. And we are outside the edges of the weekly expected move. Now we're likely to close inside this box 7 out of 10 weeks. All right, that's a 1 standard deviation, which is like 68 point blah, blah, blah. It just round up to 70. 70% chance. That's 7 out of 10 weeks that we would close inside this box at the end of the week. Well, it's not the end of the week yet, so we got plenty of time. And then 2, we've been closing inside the box consistently for a while now. We had 1 miss back here. Otherwise, that's in the box, in the box, in the box, in the box, in the box. When you get a lot of these that are, week after week after week after week, we're doing really good, well, it kind of owes us a breakout, right? It's one of the things about markets, too. expansion, contraction. What's the old phrase about volatility is when it's low, it has nowhere to go but up. We know that's not true, but that's the phrase. So if staying inside the range is considered a lack of volatility, then sooner or later it had to go up. We're breaking it. So we should close inside the box 7 out of 10 weeks. Maybe we're in the 30th percentile at this point. Looking at how far away we are from the 10-day, we're more than 1.5%. We have not yet reached that trigger where we could say that we've gone too far, too fast, and that it owes us a mean reversion, but we are very close. If we continue this degradation to the downside, that should put us into the 11, the cog line. Maybe an overshoot into the roundy, but at that point, our distance from 10 should be enough to begin triggering a mean reversion. Either way, at this point, when we finally do stabilize from the drop, it does owe us a reversal. It doesn't have to be today, right? It could be like one of these previous reversals where we closed at the lows and then we ended up jumping. It could be that style. It could turn into one of these, right? Where we close down here and the next day we still close in the lower half, and then the next day after that we finally get somewhere. Still, the next day after the big drop, we didn't go deeper. We just stayed there in the lower half. You got this style where you get the big drop and you gap into the half and then stall out. So we got a lot of ways that this could play out at the moment, all of them which don't continue to go lower, right? If we continue to go lower, well, then that's an entirely different thing. It could be, right? We could get something like February and March and April of last year where we just sank lower and lower. But remember, this was all tariff talk and, freaking the whole world out when he started really hammering down on those tariffs, and everything sold off, right? We're not in that environment. We don't even have that kind of backdrop. So there's no reason to anticipate that sort of behavior at this point. So our distance from the 10-day is deep enough at this point that we should begin looking for mean reversion. Notice the previous examples, it doesn't have to happen right away. It can last 2, 3, 4 days, depending on the headlines or the news that caused us to drop in the first place. And the fact that we've made these moves without a headline kind of implies we're not going to keep it. Looking at our distance from the 10-week, we're barely 1% away from the 10-week to the downside. That's nothing. You can see the previous example of when we were this far below the 10-week and we went right back up again on the very next shot. Could it linger? Yeah, just like back here with that whole tariff situation, February, March, and April, we could get under there and we could stay there, but we're going to need a narrative. A significant news event that just continues to linger day after day after day, pushing the market into that negative bias, and we don't have that. So the higher expectation would be that we take a little dip and then we rip. And at the bare minimum, we at least recover the previous drop and get back up into these levels, right? 69.20s, 69.40s, that sort of thing. Looking at what's down the day, we got Bitcoin. The Mag 7 up volume is down. Communications. Really, that's about it. The benchmark we use is 0.5%. So all of these that are not down 0.5% really don't count. If you're doing your version of the morning briefing later today, use a higher number. I use 0.5% because of how early we're doing this. And of course, we're doing this as a teaching tool. I'm not trying to give you my take for the day. That's just a bonus that you get. I'm trying to teach you how to do this for yourself, so eventually you don't even need me. You just do it on your own. So if you're performing this later, say at 9 or even 9:15, closer to the market open, use a higher percentage value than 0.5%. Looking at what's up this morning, uranium, gold miners, Mag 7 down volume is up. Uranium again. The KWeb constituents, China group, China again, China again. Chips. So we don't have the Mag 7 group, but we do have the opportunity for reversal simply because we have the chips. I just don't think the chips are going to be able to get it done by themselves. It's not like we're getting some sort of mean reversion in the chips because over a 5-day period, they're barely down at all. We need the others to come in, right? And by the others, I mean consumer discretionary, financials, some broader technology. Chips by itself, I don't think it can get it done. They need some help. Bitcoin can help out, right? They are an institution of risk. If they're willing to take risk in Bitcoin, they're willing to take risk in everything else. All right, we could be developing my failed flag play, right? We need to build a bit more of a base down here so that it presents as more of a flag. This is the 15-minute version. So we could build it out here quite a bit, right? But eventually we run it back because a failed flag would start to turn into a cup. Maybe that cup gets a handle, then, a continuation. But we need to build that base out. For the fib lines, you would run it all the way down, right? Which should give us a 786 right around that 60 area. Yeah, kind of like that. So this is the channel, and we could stay inside that channel for a while, all day today, even 2 days. It wouldn't bother me at all. It actually strengthened the reversal on the way back up. So that's right now, that's the possibility of our bear flag. Whether or not it turns into a failed bear flag would be getting above that 68, 63 and working our way back the other way. I love that trade. We don't get it often enough. It's not like yesterday's 111. We get a lot more of those on a week-to-week basis. But this can be a great trade, especially if you catch it along those lows before it ever breaks out above the 786, right? I'd rather buy off the lows than buy on a breakout. So we got our levels. We know the events that are on the table for today. Keep your eye on the clock. Be careful. Be safe. I'll see y'all tomorrow.